And this is what we pitched to them was, they just had a deal that fell through, and we believed that they would value a buyer who had done these deals before, who they had confidence would be able to close this deal.
Right. So we pitched them on ourselves. And for us at this point, doing a deal this size, it's almost debatable whether we should do it just from a time investment standpoint, where it's crazy to think 10 years ago, $4.85 million would have been one of my bigger deals.
Mm-hmm.
I had bought one that size and one for like $5.25 million. And those were my two biggest deals. And now I look at it and go like, this is like not worth time.
Right.
Because it's a different deal too. I have overhead and, we can raise more money. We can go after bigger deals.
Mm-hmm.
But the returns are so compelling. It's like, let's get after it. But for that seller, he's looking at us going, these guys are buying $30 million deals,
mm-hmm.
$15 million deals. We're telling him, like, we're literally saying this would be easy to close to him. Like, This is no problem. This issue you're running into, we would have known it's a problem. We would not be using that loan product.
Mm-hmm.
You have to go, we'll get into the debt later, but we know what loan we got to put on it to close it and get the financing we want. We already know how to do this. It'd be easy. I'm Drew Breneman, and this is the Rise and Invest podcast. I bought my first two properties as a 19-year-old with my own money that I earned from an online business I started in high school. I've now grown my portfolio from that first duplex to hundreds of millions of dollars of investment property. My goal with this show is to give you the resource I wanted when I first started out. Subscribe to our podcast where I break down real-life stories, tactics, strategies, and current market information you need to be a successful investor. Welcome back to the Rise and Invest podcast. We recently closed on another deal in Phoenix and wanted to get on here and shoot an episode about it. My guest today is Sam Markin. Welcome.
Thanks for having me once again.
Yeah. No, happy to have you back. And yeah, Sam, he works for our firm, and a big part of what he does is finding deals and underwriting them and pushing them all the way through close. So Sam found this deal off market and wanted to bring him on and chat about the deal, the price, and kind of just a little breakdown on the property, high level. It was a 21 unit deal. We paid $4.85 million. Again, it's in Phoenix, in the city of Phoenix, built in 1985, 21 units. And like a big strategy we have is finding off-market deals. And so we, what we did on this was we did find it off-market, but through a broker. Mm-hmm. So maybe Sam, you want to tell us how the deal came about?
Yeah. So, we're always trying to kind of get creative and, find different ways to access, these deals, whether it be direct to seller or through, brokers who haven't officially listed the property. So, for this, I was on CoStar and found a way to pull a list of every single broker that had done at least one deal in the Phoenix MSA.
Okay, nice.
From the past 12 months. So it ranged from, people on the most active teams all the way down to, some people on teams who haven't done as much. And really just started going through that list and calling or emailing, just trying to find some way to contact every broker on there. For this deal, in one of those calls, a younger broker answered the phone, and, I told him about our company, what we're looking for. And he mentioned that he might have a property that he knew of. He wasn't officially the selling broker on it, but he knew the seller and knew that he was currently under contract with a first-time buyer. So, somebody who has never bought a multifamily property before, but thought that the deal might not close. I think the reason was that the buyer was trying to use agency financing and the property was not stabilized. Something you learn as you're in the business a little bit,
right,
that's not going to work.
Right.
So
you can learn more about those episodes too. We did those loans. We shot a recent episode with Jim Boza. If anybody wants to check it out, I don't have the episode number in front of me, but that one, that's all Jim Boza does. And I've just to jump in, we've done like 30 loans with Freddie or Fannie. So when you said that to me, I go, there's no way they're closing this, because they sized the loan based on the lesser of the LTV or a 120 debt cover on that program, 125 debt cover on the conventional larger loans. And like, I know that the loan proceeds are going to be tiny on that, because it's like a half full building. So
right, exactly. So, you know, you were confident, you know, as soon as I told you that it wasn't going to close. So, you know, we had the broker send us some info on the deal, and, you know, I plugged it into our model, and the deal jumped off the page. We underwrote it at the same price that the previous buyer had it under contract for. So, you know, that's a price from 3 months ago, you know, whenever they initially went under contract, and we were underwriting it at that price to see what the deal looked like. You know, we didn't know yet what they were going to ask from us, and you know, if they wanted to take it back to market. The broker mentioned that the seller had thought about doing that, but you know, ultimately, I think, you know, they valued, and this is what we pitched to them was, you know, they just had a deal that fell through, and we believed that they would value a buyer who had done these deals before, who they had confidence would be able to close this deal.
Right. So we pitched them on ourselves, and for us at this point, doing a deal this size, it's almost debatable whether we should do it, just from a time investment standpoint, where it's crazy to think 10 years ago, $4.85 million would have been one of my bigger deals. I had bought one that size and one for like $5.25 million, and those were my two biggest deals. And now I look at it and go, like, this is like not worth the time, almost, because it's a different deal too. I have overhead, and you know, we can raise more money, we can go after bigger deals. But the returns are so compelling. It's like, let's get after it. But for that seller, he's looking at us going, these guys are buying $30 million deals, $15 million deals. We're telling him, like, we're literally saying this would be easy to close to him. Like, this is no problem. This issue you're running into, we would have known it's a problem. We would not be using that loan product. This, you have to go, we'll get into the debt later, but we know what loan we got to put on it to close it and get the financing we want. We already know how to do this. It'd be easy.
And you mentioned that, you know, this might be a deal that we wouldn't even, you know, consider just based on the size of it. But, you know, it did check a lot of the other boxes, the vintage being, you know, 1985, you know, the loss to lease that was in place, and the location, which is it's in North Papago, the North Papago neighborhood, which is very close to Scottsdale, to Tempe, to Midtown, and even downtown Phoenix. Everything is within a 15-minute drive. So, you know, it's right central East Phoenix, which is, you know, a pretty prime location. It's not, it doesn't garner the rents that living in Scottsdale would, or, you know, near Old Town. But, you know, as the rents continue to rise there, people begin to look to more affordable areas that are still, you know, within range of pretty much everything. So we really liked the location, and you know, got into the numbers a little bit, and it looked even better.
Returns were great. And I think the one thing we've noticed in Phoenix, and I'm sure it's present in a lot of other cities, actually the highest rent growth is in the areas that are more like price wise, or like, you know, priced in the middle, where you have a lot of people pushing down from the more expensive areas as those they get priced out into areas that are still nice but haven't seen the same high rents. You know, same things happened in Chicago, where you know, first it was Bucktown and Wicker Park, and then Logan Square, and then more on the north side along the lake, Andersonville, Uptown. I mean, where it's getting nicer. And all those neighborhoods I'm mentioning, you know, similar thing, where that and the deals I bought have had the highest rent growth, and those deals, not in the more established neighborhoods.
Right.
So we like that. We already knew that. And so it's in a nice area that, it's not, I wouldn't even call it like up and coming. It's just not as expensive as Scottsdale or Arcadia or some of these places.
Right. Like the in-place rents even, which were below market, are still well above, some of the other deals that we've looked at for 1-bedroom units, in South Tempe and in certain areas of Mesa. So you're right. I wouldn't call it, an up and coming area. It's already there compared to a lot of the other neighborhoods and cities in the Phoenix MSA. It's just, slightly more affordable, and you still have access to, a lot of the same locational amenities as, being right in the, coveted Scottsdale areas or some of these other higher priced neighborhoods.
Right. So then, what we liked about the deal, I guess we'll get to the returns shortly, but really it was the returns, what they were for the risk involved were great, because that's another thing you got to look at, where this deal we bought after it was done being renovated.
Right.
And so it was, I think what the current owner, they had a price in mind on the rents. If I could renovate and get to this, then I'll be happy. His investors and everyone will be pleased with the deal. And since, so he delivers the product, it's finished, he starts renting out the units, but the market in Phoenix has gone up so much that whatever he had in his head, which might have been $1,200, because I think that's what they're all mostly rented for. By the time we look at it, market rent's $1,350, maybe $1,400 on that.
Right. Yeah. And the level of renovation is something I want to touch on quickly. Very high quality renovation, which is something that we liked as well once we got the photos and, before we had gone to see it, but, full backsplash in the kitchens, stainless steel appliances, nice, vinyl flooring and new tile backsplash on the showers, new vanities, new quartz counters. When you go into the unit, it feels big, feels fresh, feels new. That's what it looked like in the photos before we had ever gone in. But the outside had undergone a, exterior reno, paint, certain aspects of the roof, which we'll get into later. But there was some slight deferred maintenance, which we're going to address, but nothing major. The renovation was done really well.
Yeah, and I think let's just get into that, where I think on every deal when I first started, I would go, this is a new building. It'd be like a deal like this one. I don't need to spend any money. The renovation's done. That's how I would underwrite it to start. And then every deal you go there and you need to do something every time, so now we would get sent a deal like this, and without doing any additional work on what needs to be done, let's say you haven't gone to it. Because one thing that I'm big on, and we do on every deal, and I did the same thing when it was just me underwriting deals and looking at deals. I always underwrite the deal first before going and seeing it. To me, it's a total waste of time to go look at a deal if you didn't look at the numbers.
Yeah, agreed.
We paid $4.85 million for this. If we would have underwrote it and been like, this thing's not even worth $4 million, why go look at it?
Right.
So we're just aware, especially once you've seen a few buildings and you kind of get the gist of what these things are like, you're not even learning anything going, I don't feel like. And to me, I like to underwrite it, and then you have sort of questions in your head after underwriting it, where like a big thing in these buildings that when we had bought them in Chicago, we have assumptions for there's internet at the building, they're cleaning the hallways this much, the trash should be this. We have some numbers from them, but usually a lot of the sellers' numbers are they're taking out any non-recurring expense. They're trying to make the expenses as light as possible.
Right. So
then once you underwrite the deal, you have in your head all right, I need to go there, I need to confirm how many elevators they have, because then that's going to dictate how much the elevators cost. What sort of what are the hallways like size-wise, because maybe I'm not underwriting enough for cleaning. I'm not going to necessarily use the same setup that the current owner is using for hallway cleaning. I don't know what they're doing, so I need to evaluate the size of the hallways. But it's hard to do that once you haven't put any numbers down on paper. Yeah. Because then some of these, if you go, this building's just like the other one, you don't need to be worried about that. If you already can confirm ahead of time, there's just only cable going to the only internet going to the building. There's no phone line. There's no anything else. Then you can just grab that, and then it's in your model. Then when you go, if you realize, okay, there's internet and 2 phone lines, now you're just thinking, all right, I need to add phone lines to my expenses or make adjustments. So I'm huge on that, especially on these deals on the expense side for operating expenses, because then you can go through and sort of see what's there.
Yeah. And, you hear of certain groups or certain people in the industry and different investors saying that, I don't underwrite deals, and, I know the market extremely well already. I don't need to underwrite it. I know a good deal when I see it. And I'd argue, and I think this is the approach that, our entire group uses to approach deals, is that, in doing the underwriting, it makes you think critically about the different aspects of the deal. So that's, and then you get to those points that you're saying, like when you're plugging in those numbers, it makes you think about, we have these different contract services that are going to be recurring. What are the costs of those? And what's, the annual cost? And then to get to the deferred maintenance, that's exactly the exercise we went through. I think we, just plugged it in initially at a value of, $50,000 in deferred maintenance, which is something we do on all of our deals. There's always something, as you mentioned. So
just to jump in, it's relative to the size.
Yeah.
So then to me, what would be a $5 million deal in my head, 50,000, you're going to be able to, and there's just always some stuff to do. But if you're buying a $20 million deal, 50,000 is not enough. But it's relative to the size. But continue just to.
Yeah. So that, that's pretty much that in, what I think about underwriting the deals. I think it's pretty valuable and a good way to, kind of have your mind grasp the different concepts and what's going to be happening at the property.
And I think for those sort of more emotional buyers that you're talking about, that works fine if you have your own money and a longer hold period. It's a pretty difficult to not make any money if you're just going to buy a building and have it for 10 years.
Right.
But if you're going to send deals to investors and explain to them what their returns might be from your projections, like you need to have underwriting.
Yeah.
They're all expecting that, and then you would need to be able to articulate your business plan and what's going to happen every year. But so that's definitely right what you're saying. And then the folks that are buying just on, whatever price per foot, price per unit, whatever their metric is, that it's interesting too. You see them, usually they end up buying the same type of building.
Right.
There's a lot of people in Chicago that it seems like that buy per unit. They're just buying the same type of stuff that's like what they have now. And it's like from a vintage standpoint, like age and condition. And then it's interesting, their whole portfolios is kind of the same. So in a way they sort of know, like, okay, if I pay this much per unit, I'll make as much as the other one.
Yeah.
But then that's not, so then that could work for you if you're just like an individual buyer with your own money.
Yeah.
But it would be tough to be starting out doing that.
Definitely.
If you're, I think back in the old days before people were underwriting on Excel and stuff like that, there were probably more deals to be had that way. Things things that weren't marketed well. But now this real estate's gotten a lot more efficient.
Right.
You really need to have your numbers dialed in. And then on the CapEx stuff, I think, so we put 50,000 in our model, and then you go there and I went up on the roof, and the roof, they didn't do anything to it in the renovation. So it needs, in Phoenix, these roofs are flat roofs, and they have this elastomeric paint on it, and it's not that cheap to repaint the roof. Like in Chicago, you're putting down a much cheaper, just like a gray roof paint of some type, and like that's far less expensive than what's in Phoenix. So we went there, and so we saw that it needed a coat of paint and to be cleaned off as well, because a lot of debris on the roof. Trees cut back that were overhanging the building. That's how all stuff was getting on the roof. And then some spots where the roof material was like breaking out from moisture around the AC condensers. So then, right there, you go on the roof and you go, okay, here's $10,000, $15,000 of just more like maintenance. Like, so we need to really do this, get this dialed in right. So then if we're going to own this thing for like 3 or 5 years, they're not going to experience any problems, and it'll still look fresh for the next buyer. Or right before we sell, we can go put another coat of paint on it on the roof potentially, but then all the repairs, and it's been like maintained since.
Right.
And then as well, we go, and then really the only thing they didn't sort of finish when you look at it, it's been painted. Everything looks new and fresh outside and inside, but then the parking lot wasn't touched.
Yeah.
So parking lot is blacktop parking lot. The parking stall stripe lines, those are all faded, and the parking lot needs a refresh.
Yeah. Alligator cracking throughout, and I think once the parking lot gets a refresh, it'll just kind of make it pop a lot more and make it look even nicer with the the white paint and the new blue doors and windows. So
yeah, for sure. And even that's sort of that's a maintenance thing too, where if we do nothing, like eventually if that alligator continues, like the parking lot will need to remove all the blacktop, or mill it down and put a whole nother, like redo the parking lot. So you could spend maybe $15,000 now or less to put another 1 inch, let's say, layer of blacktop on that. Or you could, you don't do anything, the next buyer is going to look at that and go, I need to spend $60,000 doing an entirely new parking lot.
Yeah.
And the thing is, to me, if I'm a renter there, I just saw this thing online, looks brand new, and then I pull up on this old parking lot, just doesn't seem all the way done. So that's going to cost you, on the rent too, I think.
Yeah.
So that to us was just like you have to do it, that kind of thing.
Yeah. And the other thing I'll note is, you mentioned the next buyer, and, we initially engaged on this deal and put it under contract without, having done the building inspection yet. We did that later. But to just kind of get to our philosophy on, those types of items, something that you've stressed to us is that, you don't think it's worth it to retrade after the inspection, based on having to redo the roof or, needing to pave the parking lot. It's more important to, be easy to work with and keep those relationships strong, because, you never know if this investor who currently owned the building is going to be selling something else. And, he'd value working with, somebody who's easy to work with. And, you can't go into buying a 1985 building and not expect for there to be, some issues.
Right. And where we would ask for a retrade, let's say, is if let's say we asked about the roof and he told us it's brand new.
Right.
So then we would have changed our number from 50,000 to maybe less going, or if we asked him, what is there to do? What's the roof like? What's the parking lot? And he would say, it's all brand new, everything. You don't need to spend a penny. Then we would, we would drop our $50,000 to $10,000 probably. And then we go there, and then we would, because we were told that, now we go, oh, this is new cost that doesn't line up with what you told us. We have asked for price adjustments then, or credits, because there was a deal I bought where we were told on the ground, brand new roof. We went up there, it's like 20 years old. Yeah. I don't know what, and they lived at the building, so I don't know what, I don't know how they could have not known that, but whatever. So for that, I got a roof credit. Yeah. Because it was different than what we were told. Yeah. But to your point, we're explaining to them, we're experienced buyers. We know what we're doing. You can't roll up there and be like, oh, we need to paint the roof, I need $5,000. Yeah. There you look like amateurs. Right. And people have done that when I've sold, and they do look like an amateur to me. So I think that's big, because one thing, just to clarify that, where it's on those small items, where if it's, anything where, I could think of more than one deal actually where we got a roof credit, where we were told the roof's great or new, and then it wasn't. But in general, if we're only doing any adjustments if it doesn't line up. Yeah. Like if you told us on another deal, we were told no rent concessions, not a single one. And there was, every unit had a month free on it. Okay, well, now our spreadsheet doesn't match what we're buying anymore, because when we were out front, you said not a single concession. Yeah. If you would have not said anything at that time, this was in Chicago, we would have probably underwrote a half month free on everybody on that type of deal. And then there would have been a different conversation. So it's only when things don't line up. Otherwise, I've never asked for these like small things. Yeah. And then that helps where all the brokers and sellers, they want a smooth deal. And having been a seller myself, I realized like just because you sign up a deal at what might be the highest price doesn't mean you're going to close at that.
Mm-hmm.
On a deal that I sold last year, I mean, I probably got asked for like, no exaggeration, 15 things throughout, just different adjustments.
Yeah.
It's
frustrating.
It's normal to ask for some things. It's
Yeah.
not like we don't ask for anything, but maybe we're asking for like a couple things,
Yeah.
and a lot of them aren't even like money related. It could just be a little more time or something or.
Yeah. And I think if it is money related, it's best to do it all at once you have all the information.
Yeah.
Versus
How'd you learn that?
Heard it from somewhere.
No,
I
just
don't
kidding.
remember where. But yeah, I mean, that's another thing that you've taught me since being here. So
download our 100+ page passive investing guidebook today at riseinvest.com/downloads. Accredited investors can sign up for our multifamily investment opportunities by hitting the Invest Now button on our website. Now back to the show. That's a good point. It's always much better received if let's say this deal we didn't have any price adjustment during due diligence, and then also we haven't had any recent where we've done that. But if you do, what's best is you complete all your due diligence. So to your point, I'll just elaborate on it.
Mm-hmm.
You complete everything. So then let's just pretend if we needed a $50,000 roof credit on this deal, we would go to them and go, we've done everything. We've read every lease. We have read every contract. We did our physical. We put our camera down the sewer. We're done with everything. Phase 1 is in, surveys going, like we're done. All we need is the money for the roof that we were told was new,
Mm-hmm.
and it's not. And then that is much better for the seller to hear, because then they are doing, I give the 50,000 or whatever the credit is.
What's next?
And now, no, I'm saying if you ask it our way,
Yeah. Okay.
and then you go, all right, then it's done and we move on, we're closing.
Right.
You ask piecemeal, you really wear them out.
Yeah.
Maybe they say yes on the first one, then you ask for something else. It's just like too much.
Mm-hmm.
And then they are, then they just turn into a no machine.
Yeah.
So, and then too, that's just a bad way to deliver all the stuff, just piece by piece.
Yeah. Agreed.
So a lot of times I'll, update maybe the broker, like, hey, we found this,
Mm-hmm.
but we're not done their due diligence. So just want to let you know, we don't have like an ask right now, but we like realized like the leases don't add up to the rents we were told, or
Right.
whatever the problem is. I've done that before, just to have it on their radar.
Yeah.
Like this. So if when in 2 weeks when we've completed everything, but you told us the rents were $50,000 a month and they're $49,000 a month. Like,
Mm-hmm.
what do you want to do?
Yeah.
Like that's not a total surprise.
Yeah.
They've known
makes
about
sense.
it. They've known about it for 2 weeks, and in a way, it's almost like good news. We haven't found any other issues. So it's just that. And then, okay, nice. But yeah, so for the actual deal, I mean, what's simple with this buying Desert Palms is the name of the property, and buying this was really, you take the $1,200 and we got it in our notes here, $1,228 a unit on average, and you turn that into a $1,400 unit. Sam, what does that do for the value or for the property?
Yeah. So, assuming a 4% cap rate, which, the in-place cap at us buying it today based on the in-place rents is about a 3.1. So, assuming a 4 cap based on the market rents today, that would value the property at around, I think, $6.25 million, which is roughly a 29% increase to our purchase price, which is pretty good,
Right.
When you think about it. And I think that the stabilized cap that we were stabilizing to in year 3, it's the market rents over the current all-in cost was over 5%. So
Yeah.
when you look at the Phoenix market, and sorry I ut you off, but
I'll keep going.
and things are selling at a 3.1 right now, or maybe a 4 after you capture all the loss to lease, which we hope to do. But the market's been moving so quickly, people renew leases, and you don't necessarily want to drive everybody out by raising the rent exponentially on them. So there could be loss to lease by the time we sell it, and hopefully we're hitting our projections. I think we underwrote 5% rent growth a year, which based on our in-house models, I think the prediction for the next year was 7% on our single variable model and 9% on our multivariant model. And over the next 3 years, I think it was, 7, 9, and 5. I have it written down here somewhere, but it was over 5%.
Yeah. And then I have the notes in my computer where this is, it is 7 and 9 on the two models. And then and even that just lines up with the historical numbers too. I mean, Phoenix, last 10 years been like 8% rent growth. So it's just, that's just what it is. And we underwrote 5, cause that just already feels like a lot and the deal worked. Typically we're underwriting 5% rent growth. But yeah, to your point, I mean, a lot of deals in Phoenix, if it, there's no deals that have no loss to lease because the rents have gone up so much. They've gone up the last couple of years, 20% plus a year. So if you sign a lease in, I don't know, May 2021, and now you're going to put the unit on the market today, well, the rents have gone up, for 10 months now at an annualized number of 20%. Your deal has on that unit, you're 15 to 18% below market now.
Right.
So it's hard to say what's a stabilized cap rate, but let's just say if all the rents were at market, this would sell at a 3.5 cap is kind of how it feels to me. Maybe a 3.75 cap rate. And then so what are we doing? We're trying to find deals where we can in year one, or when our business plan's done, if it takes longer, like with the renovation, stabilize where you're at a much higher yield on cost as a term. So just your new NOI once you're stabilized divided by your all-in basis, so price plus renovation if there is any.
Right.
And on this one, we're in at a 5.1 yield on cost, which another way to say that would be like your end of year one cap rate is 5.1. And so then in the market where things are selling in the 3s. So then that makes a lot of sense. Interest rates can change, cap rates can go up. You're still making a great return because you're more or less, if we hit our numbers, it's like we bought this at a 5.1 cap,
right,
without having to do any renovation or any risky work.
Yeah. So the risk adjusted return was there.
Right. And so then, because what I keep saying is, let's say, so now we stabilize at a 5.1 cap on this deal. That's a higher cap rate than if you just bought a fully marketed deal in like Wisconsin or Minnesota or places that aren't growing nearly as fast. So then to me, it's like, where would you rather be starting in year 2? City of Phoenix or, somewhere in Wisconsin or Ohio? You just pick your place where it's still like a high 4 cap.
Right.
So that to me is, super compelling. And that's why a big reason why we're in Phoenix, because we're capturing deals like this where we can stabilize them far in excess of where today's cap rate is. And then we assume we sell it at a higher cap rate to be conservative. So then on our numbers, we're selling this at like I think in our model, like a 4.35 cap.
Yeah, 4.3.
Okay. Yeah. And so then in today, where in cap rates are in the 3s. So we trended up our cap rate a ton, but the returns are already so strong. It was just doing that to be careful.
Yeah. It's a 3-year hold. So we did trend up the cap rate considerably from, at least where we're buying it and where we would expect somebody else to buy it after us, when it's completely leased out. We've hopefully captured, a lot of the loss to lease, and they're buying, a stabilized, completely renovated building. So we underwrote to a 3-year hold. And something I wanted to touch on that came to mind as you were talking about, the rent growth numbers, was that if we were holding this longer than 3 years, that those rent growth numbers that we underwrite, it wouldn't stay at 5. It's a lot easier to predict, the short term and, based on our models, but we would pretty much certainly, bring that back down to a normalized, 3% growth into perpetuity if we were underwriting a longer term hold.
Yeah, makes sense. And what's interesting is that's sort of just more of like an industry norm, eventually underwriting to 3% rent growth, but that's almost, hasn't happened in Phoenix in in so long. And I think the average, since we've got, I don't have it in front of me, but it's like 8% a year. So then and with apartment values going up an average of 10% a year.
Right.
So then that is, that just that's super conservative when we get in those later years.
Mm-hmm.
But this we underwrote as a 3-year hold.
Yeah, I think the last 10 years was 8%. Yeah, that's what you said.
Yeah, and I think then, and so what we have for returns on this deal, and this is what we sent out to the investors, or we had
no, this is not initially. We sent out something slightly lower than this. We initially underwrote lower rents. I think it was $13.50 for the one beds.
Yeah.
And so we showed lower returns, and the deal still looked great. So it's better to under promise and over deliver. But once we figured out that we could push 1,400 here, and while we were under contract, we even got a few applications at that $1,400 rent, which is proof of concept right there. We're thinking we could even push these higher,
Yeah, right. We're year 2 rents or beyond, and while we're under contract.
Yeah. So it was pretty promising. The deal already looked great. We wanted to get this closed, obviously, and as quickly as possible. But to touch back on the numbers and the returns, exiting at that 4.3 cap on our, adjusted underwritten numbers for the higher returns, the residual value was around $7 million, and that would equate to $333,000 a unit and $494 a foot, so under $500 a foot. For context, we're starting to see deals trade now in the upper 200s in similar areas already. You have to take into account that this is one beds, but they are large one beds, 700 square feet. Sorry. So, and we also saw a comp recently trade by the property. It was all studios. So super small square footage on the units. That went for over $500 a foot. And it was an older property, no in-unit washer dryer.
Was it renovated?
In the studio units. Yeah, it had a little renovation, but they're all studios. So, it's not an expansive kitchen in there, and there was no in-unit washer dryer.
Yeah.
So,
but if it's studios, I'll say I would expect that to be high per foot.
Yeah,
so
definitely.
The studio. So then that doesn't,
the per unit pricing was still greater than what we were acquiring.
Okay, nice. Yeah, that tells me a lot.
Yeah.
The per foot on studios, it's always like the highest.
Yeah.
And that's
it was like
nice.
$250 a unit plus.
Okay, nice.
Yeah.
So I didn't ruin your point.
No.
Okay, nice. I opened our original LP memo. So yeah, we sent out net investor returns on the 1350 rents of a IRR of 19.3 and a 1.67 equity multiple. What we've realized, this is most LPs are targeting the 15 net IRR, if that's your metric. So, right, we look at this and we go, we're already pushing out a 19. Then we get into due diligence. Things are improving. Now on our new $1,400 rents, we're pushing to a 21 or 22 IRR. I don't recall updating everybody. I
think we sent out a note, but not an updated memo or anything.
Yeah, where I don't recall where we weren't like projecting, hey, it's going to do even better. Right. It was just unnecessary, where by then we already had raised all the money and we were already projecting 4% higher than what most folks are looking for.
Right.
So I don't recall doing that, and I'd recommend other sponsors or people raising money kind of take a similar approach where kind of figure out what everybody's looking for, and then underwrite conservatively. And if you have good news, you can inform people, but then we don't need to re-update everyone and say, hey, 22% is a new number, and then you deliver a 21 and people are like you missed.
Right.
But originally we said 19, so I'd rather give the update, I think, where, hey, they got apps at 1,400, so we're gonna kill it on this, but I would not send around new numbers. And you already like the deal as is.
Yeah, definitely.
And part of the reason you invest with us is we underwrite reasonably and conservatively. So then like this is not a surprise then when I hear this potentially. What I think one thing then to touch on that's important is the debt next, because for me, if I hear the returns on a deal and I don't know what the leverage point is, it's not telling me anything.
Given the deal profile, roughly $5 million, we knew that we would want to, lever up on this deal and go probably hit 75% LTV. So, that would equate to roughly $3.5 million loan. So we knew that bank financing was the best route to go, most competitive. And that's, where you go under $10 million, I'd say. Is that?
Yeah,
right?
I think it depends what you're talking about, because obviously banks can go to any amount depending on the bank size. I mean, these banks do have legal lending limits, but any bank can go over 10 million.
Yeah.
But your point, I'll elaborate on because I do know what you mean. It's if you want a non-recourse loan on a property, you can go to Fannie or Freddie, and then they start at like $1 million.
Yeah.
But and then we're talking if you want to be, let's say 70% plus LTV, I'm talking about right now. So you can go to Fannie or Freddie. The issue is they are sizing on, just like we already touched on with the previous buyer, just in place cash flow. So it doesn't work for this deal. Next option, if it's over $10 million and you want to be non-recourse, is you can go to a debt fund. There are these funds where they raise money and they don't buy properties, they lend on properties. And most of them are sizing to a stabilized NOI. So they'll go, okay, you're buying this today, and when you're done with your plan in year 2, your NOI will be this number, and we want to be at a maybe like a 130 debt cover, a 7 debt yield. The debt yield is just your NOI divided by loan amount. And because then if you're at 7, then you go, okay, rates raise, but I still have all this like space. If rates go to 5 and the property's yielding 7 on the debt amount, like we'll be safe. They can refi and make their mortgage payments, and the loan will size out. So to your point, we look at this, it's a $5 million deal, and then it's too small for debt funds. And then and also, even if a debt fund would go below 10, these loans are not cheap to close. I mean, we're working on one now and it's hundreds of thousands of dollars to get this thing closed. But it's the $23 million loan. But it's going to be and not like, when I say hundreds of thousands, not like 200,000, like this would be
the closing costs on this deal specifically were not terrible.
And that's what you get with a bank. It's going to be less expensive, and then to close, and then the downside, if you will, is that it's typically recourse lending. So meaning like someone needs to provide a personal guarantee on the loan. Different banks do things differently. Some banks, they'll do a limited guarantee. So let's say you can do a 25% guarantee. So if the loan amounts $3.5 million, you are guaranteeing 25% of that 3.5 personally. Most banks don't do that. Most just want 100%. And that's what we have here with our lender. And so we used a bank called Bridgewater. They're out of Minnesota. I've closed with them before. They're great for flexibility and just really, really great. Can't say enough about them. And if you're looking for bank financing, you got to start out, I think, in Minnesota as a client. So depending on where you're listening to this, it might not work. But I started out there and did 2 loans with them on Minnesota properties, and now they'll follow me anywhere. That's how that works.
Were those on, was that multifamily property or shopping centers?
Yep. We had a deal actually where we were under contract on our 6th deal. So it'd be a good story for another day, actually, where we're buying a shopping center. We've done 5 loans with one bank on the previous 5 deals. And we get the 6th one under contract. They go in for like approval on the loan. This bank we've done all the loans with. And they go, you hit the legal lending limit. So banks, they have a limit based on their size, how much they can lend one party. So then whatever that limit was for that bank at that time, I think it was like $25 million. They're like, we've already lent it to you. We can't make more loans to you. So,
and then you found Bridgewater?
Yeah, because where I worked, I had worked at Dominium in Minnesota, a multifamily developer, and they had done loans with Bridgewater, and it talked about their flexibility and creativity. So I called the CEO of the bank, this Jerry Bach and was like, hey, I'm in this, we never talked before. I used to work at Dominium. I know you're like a great lender that talks so highly of you. I'm in a deal right now. We have like 30-40 days to close, and I like just got told like I can't proceed with the bank I'm doing. How fast can you guys do something? And he was just like, send me the numbers. I don't think the timing will be a problem. And they closed it on time.
Nice.
Yeah. So then we so I said 2 loans, because then we like later refied that deal.
Yeah.
Like we bought that shopping center for $2.95 million, redid every lease, some tenants left, some we popped in new ones. It's worth like over $5 million now.
Yeah.
So, but it's the same play as this building, more or less. Rents are below market.
Right.
When the lease come for renewal, you get increases, or they go and then you just move into new business who can pay the higher rent. But they were paying $20 a foot in like a $30 a foot market.
Yeah.
So, and then Panera, they spent like $800,000 of their own money putting in a drive-throughs, so they're never going anywhere. So
that's
it's
quality.
Good.
That's value add right there.
Yeah, I know. And then over time, we improved the tenants. So we went from
Yeah.
a liquor store on one end to Shopco Optical now, who's in there, so like a medical user and then a chiropractor.
Nice.
So we've improved
Sticky tenants.
Yeah, and quality, just everything. So
Yeah.
then that's going to drop the cap rate too. So yeah, we'll get into some commercial property podcast soon, so then bank financing, you that's going to be your best play on not a fully stabilized deal under $10 million if you're willing to sign recourse.
Right.
If you're not willing to sign recourse, there are other lenders out there, but you'd have to be at a lower LTV. And we like this at 75% LTV. Also, like that, if that feels like a high leverage point, let's say to you watching or listening, well, how we're looking at that also is we're about to take this thing from 5 million to 7 million of value. Maybe that doesn't, if you think that pans out, that we're going to be at like a 60% LTV in 18 months.
Yeah.
So that's the other way we're looking at it. Like I see a lot of people where they want to be at 60% LTV. So they start at 60, then they create the value, and then 18 months in, they're spending, 2-3% of the loan amount doing a refi, and that's money for us we're just going to have in our pocket, so to speak. We don't need to spend any more money. This is a 5-year fixed loan, 3.5% rate, 12 months interest only. We're just going to ride this loan till we sell, assuming we sell it either in our 3 to 5 year hold window, and we don't need to spend any more money on dealing with the debt. So I actually like that if you're okay with it, stepping up a little bit more in leverage going in to save money refinancing later. Yeah. That I think
makes sense.
Big takeaway.
Yeah. And then so to get more into this particular loan, 5-year term, 3.5% fixed rate, 75% LTV, and we had 12 months interest only, which, at that point we're turning a few leases already, we're hitting our rents and we're in a good spot. So that was, we jumped on that as soon as they gave us that quote.
Yeah. And and one thing I'll say, we did negotiate on the prepay actually. Originally, I think we got quoted like what we'll call like a soft step down, maybe like 4% year one or something, then 3, then 2, then 1, then 1. And they were willing to do and this was just negotiating this prepay structure that I've really liked from these Freddie SBL loans. 3% year one, 1% prepay year 2, and then it's 0 thereafter. Or as the debt guys say when they want to get fancy, prepayable at par. Right. But 0% prepay.
Open up at par.
Yeah. The 0% prepay. So what's great for us is we are just paying 3.5% a year. A lot of these loans you'll see, they'll do a loan for 3.5%, let's say, but then they sell it in year 3 and they have a 3% prepay. Just, this isn't exact math, but that's almost like you paid an extra % a year. Yeah. If you pay 3% at the end. Right. It's not exactly 1% because you obviously paid your loan down a little, but so you could almost look at that and go like, I'm actually paying 4.5 if I have this 3% prepay on the way up. So really try to match up your prepay with your business plan. That's a really important lesson. We've already said it on a few episodes. I'm sure I already know, but like that's huge. And we're really doing it because we have no prepay in the time we think we're going to sell. Right. So we're really doing what we're talking about.
Yeah. And reasonable origination fee. It's, less than a point, 0.75.
Yep.
Nothing going out. So it's good product for our business plan, as you said.
So we have our $3.5 million loan, and then we're buying a $5 million property. So that leaves $1.5 million of equity to raise. So what we did was we raised that in a 90-10 structure. And that just, the 90 is the percentage that the individual investors we have put in, and the 10% is how much we're contributing to the deal.
Mm-hmm.
Market, I'd say for these deals, it's either 90-10 or 95-5, but there's some sort of general partner contribution being made is normal. And then our waterfall structures, our incentive fee, which is a promote after a preferred return and return of capital. We've looked at a ton of deals and know what like market is for fees, and this is what we're doing on the waterfall, like especially for multifamily properties and properties that are marketed, let's say, to individual investors. Like this is the most common waterfall, what I'll say, and then also what we're doing. But doesn't necessarily, you can do what works with your investors. I've done a lot of other structures. I mean, on some I've just split 80-20 just straight up, because it's not something we want to hold it long term.
Right.
And then if you have a preferred return, there's like it's just like a clock ticking, so to speak, either diluting the returns or, making the sponsor wait to get any money. So you got to match up the waterfall, just kind of like your debt, or let's say the incentive fee, to the actual business plan. But what we have on this deal, we have a 8% preferred return paid to the investors, and that's cumulative and compounding. So if it isn't paid fully 8% in 1 year, that's tacked on to a balance that needs to be paid, and also that's building interest. That's what cumulative and compounding means. So the 8%'s building at an additional 8% a year, and then after the full preferred return is paid, then investors get the return of capital in full, and then after that's happened, then we start splitting 70-30 on all profits, all distributions, and then once the investors have made a 12, then we start splitting 50-50. So from there, and so what the returns we had said before, where it was a 19% return to the LP, that's after these splits. So the deal makes more than that, but this is just after all that, what the LPs are going to see. So anything on the equity you want to touch on? One thing we skipped was kind of going through due diligence. We talked about the physical, but not other like lease audit and stuff. I mean, where do you?
I could touch on the lease audit. I will say, when we went out to raise the money, we were fully subscribed within, I think, 2 days of sending it out.
Yeah, good point. I know when we started originally, we were thinking, maybe there was like one LP that might go into the deal and do the whole thing, and then that we ended up just opening up to everybody, where that's what we're going to do going forward. But it was just sort of, this was one of the first ones where we just kind of passed the hat, so to speak.
Yeah.
So yeah, it's a good point. We went into this kind of not knowing what to expect the most, and then we were oversubscribed and having to explain to the people that, like, I think the numbers were like about 10 people maybe in this deal. And then what do you?
Yeah.
We could pull it up, but
a
then
little less, maybe, 9 or 10.
But the last 4 came in at the same time, and then we're oversubscribed.
Yeah.
And now it's crazy to think. Then we're explaining to the last 4, like, I know you wanted to put in 200,000, but there's only room for 100 or 150 or whatever.
Yeah.
So, yeah, that good point, because that was a surprise to me, where especially at the same time I knew we were coming out with another deal, which we can touch on in a later episode, and that one was oversubscribed too.
Yeah.
So it's good, but speaks to just sort of the strength of the deals and just kind of the investment landscape today too, where not a lot of places you can get this kind of return, especially given like this deal in particular, the risk profile. Yeah. You're buying a finished building and just raising rents to market.
Right.
So due diligence, what else did we do?
Touching on, we always conduct a lease audit, whenever we're evaluating a potential investment. So when we're in due diligence, this means that we match up the rent roll that we received from the seller to the actual leases. And that's, comparing base rent, whatever other income, whether that be RUBS or pet rent that they're receiving, the security deposits on file. And I realized as I was going through on this deal that there were a number of additional admin fees that the current property management company was charging. They were part of the lease, but they were keeping them as part of their compensation. So, when we're about to take control and these leases are in place, we told our property management company to continue charging whatever was in the lease, and instead of it going to our property management company, we have a separate compensation structure lined up with them. It would come to the owner instead. So, and that equated to $75 a month in rent. So
right. So the way to also think of it, if that was like at all hard to follow, is just really all you need to know is when we were told the rent was maybe $12.26 on average, that really turned into $13.01 on average.
Yeah.
So right there, we're starting with a lower rent number than we thought. Because a lot of times you see these fees and then they go to like an offsetting cost.
Mm-hmm.
Like if there is a utility reimbursement, which is a common one, usually there's just a offsetting utility cost.
Right.
It's not just pure revenue.
Yeah. So these additional fees were net of, your typical other income items.
Right.
So the pet rent and RUBS that we initially underwrote, this is separate.
Right. So then, so all of a sudden, poof, every unit is $75 more than we originally thought. And then we get going, as we mentioned, and they get in apps at, the rent's higher than we had proposed. So we're just, higher everywhere, income wise. And then we already touched on the physical inspection, I think, enough.
Mm-hmm.
What else we do during due diligence?
During due diligence, we touched on the physical inspection. We get the survey, environmental done, lease audit. What else? Public records. So search for permits and certificates of occupancy. Anything legal issues outstanding with the property. Am I missing anything?
Yeah, I mean, we have like a whole 30 item checklist basically.
Right.
So I think that's plenty. Like we went through our usual checklist or whatever was applicable, checked everything, and really sort of the high points on this deal are just we found more income than we thought. Mm-hmm. And then we had things to do after the physical inspection, but it wasn't really any different than what we anticipated.
Right.
So we did do plenty of other stuff like pulling records and phase 1 and environmental and
zoning
survey and just all sorts of stuff. But I think that's plenty on that, where those were the high points. And at some point, I could shoot a whole episode on due diligence and probably should, or this, we have but there's plenty to do, but we, thankfully put together a checklist. So it's pretty easy. We just give it to the broker, collect the info, and then you just review it.
Yeah. And now moving on to property management, I mean, if we were doing a renovation here, I'd have a lot more to expand on this topic, but pretty much what it entailed was just, informing the property management company that we were going to purchase this property and just making sure they're informed throughout the process when we're going to take control. And then, after we close, we, pass them the keys and work to give the tenant notices.
So we are using a third-party property manager down in Phoenix. They manage like 10,000 units and have a really good handle on everything and good vendor relationships. And been really happy with them. And so that's just another deal we added with them. Pretty simple business plan after closing. So really not much there. Just need to charge market prices and continue to ride this rent growth that we're seeing in Phoenix.
Right. Yeah. Nothing on my end really. I mean, pretty simple deal.
Nice.
Yeah.
Yeah. Well, yeah. Great job finding the deal and, getting it close with me. And, thanks for being on. I mean, good job, on everything running through the deal too here.
Thanks. Yeah. It was, it's been fun. It's always a learning process. You learn something new every time. So.
No, it's great. Yeah. And it's all in your first year here. So closing deals and
closing deals.
Finding them. Nice.
That's what we're here for, right?
Yeah. So great. Well, I think that's plenty. So thanks for joining us and we'll see you on the next episode. Thanks for joining us on the Rise and Invest podcast. Please be sure to hit that subscribe button on YouTube or wherever you enjoy your podcast. If you'd like to dive even deeper into real estate investing, check out our company's website, riseinvest.com. where we have numerous free resources and information that can help both active and passive real estate investors. Our 100-plus page passive investing guidebook, our trends report, and our blog are all available on our website. If you are an accredited investor, you can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording and do not purport to reflect the views or opinions of Rise Invest Holdings LLC and its subsidiaries. The views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities, and the speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.